Good morning. This is Dylan Jovine with Behind the Markets. Happy Thursday. Today is Thursday, November 6th. And today I'd like to do one of my regular Don't Drink and Drive videos. A bit of a warning about the stock market valuation. And it prompted this. Two pieces of information prompted this. One is the Buffett Indicator, the famous Buffett Indicator, which measures market cap to GDP, is now at the highest point in its history. Warren Buffett famously said, when it gets over 200%, you're playing with fire. So Buffett says right now, we're playing with fire. It's a playing with fire stock market. The other thing is Warren Buffett has been a net seller of stocks for 12 straight quarters, which is actually historic. He's never been a net seller of stocks that many years. And famously, he didn't even deploy any extra cash to buy Berkshire shares, which is something that he does also when he thinks there's a bargain in his own stock. And that comes at the same time that we see another valuation measure is pointing to some rough years ahead. For the very second time in history, U.S. stocks have crossed a valuation milestone, which is the cyclically adjusted price to earnings ratio. And it's something that people like me are very focused on. Because you look at any company's PE for 1 year, and you can see a lot of distortions in that. A company could take a write down, or they could have a really super good year. A lot of things could happen in any 1 year that doesn't measure the earnings over time. And what I look at is the earnings over the past 10 years, the average PE and average earnings for the prior 10 years, because what that shows me, I actually go back a little bit further. What that shows me is the average earning capacity of a company in both good markets, in good economies and bad economies. So you get a sense of what the average looks like. Now, those of you who are members of Takeover Targets remember very clearly that in April when the market crashed, and I came out with that buy list on Sunday night and I sent it to you, what I did is I used a 10-year average PE. Because again, it shows us what the average PE should be, the average earnings and the average PE should be over the past 10 years, over a couple of economic cycles, expansions and contractions. Very important, much more accurate than a 1-year PE. And the Shiller's CAPE model shows that stocks are in nosebleed territory. Basically, they have not been this high since the dot-com bubble. And these measurements go back to 1881. But back then, the U.S. was more like an emerging market after the Civil War, and stocks were very widely manipulated. It was crazy. You want to start in 1990? There's a lot of arguments. That's kind of the bear argument, that stocks are very, very highly valued. Here's the counter argument, because again, we can't engage in magical thinking. We have to look at the facts as they are. What we try to do here is we try to understand that PE ratios today can be higher naturally than they were 20 or 30 years ago. Why is that? Because companies today sell across the globe. They have higher margin businesses. You think of manufacturing in the 80s when we made hats and t-shirts. Those are low margin businesses. Now, our most valuable companies are very high margin businesses. They sell software. So instead of getting a 5% return on your capital, you get a 30% return on your capital. So when you have higher returns on capital, you should get higher PE ratios. There's no doubt about that. So there's a very solid argument for the market having naturally higher PE ratios than in the past. So we don't want to go back to 1950 or 1960 when we're looking at the 10-year average PE, inflation-adjusted PE. What we want to look at really probably in the 90s when you started to see computers selling, we started to see software, Microsoft, those kinds of things, the internet bubble, .com, Amazon, eBay, and all these other high return on equity businesses. And since then, the average PE has been about 27. So at the end of the day, we have a situation here where we are now well above 40. At the peak of the .com crash, it was 42. So we're right there. We're right close to where we were right before the .com crash. And this is why you see reports that people have been shorting stocks like Palantir and NVIDIA. Very famously, Michael Burry, the investor who famously predicted the 2008 housing crash, has been warning that the AI boom looks very similar to the dot-com boom. But now he recently revealed that his firm, Skyline Asset Management, has $1 billion short position, bearish options position against both Palantir and NVIDIA, two of the biggest winners from the AI frenzy. At the end of the day, we're going to see, I told you, I learned never to short because the Tisch family went short in the 90s during the dot-com bubble. The stock market kept going higher. Valuations were obscene. They were stupid. Everybody knew it. 96, 97, 98. And he kept going short, and he kept losing billions and billions. He lost billions of dollars going short because he was right on valuation. He was right. Things were overvalued. He was wrong on timing. Timing is important. So a crowd could stay insane for long periods of time. So what we don't want to do in things like this is take positions like that. We don't want to bet when the flock of birds, the collective flock of birds that is the stock market, suddenly decides to turn left or turn right. We just want to go with the flow, but keep an eye on the door, keep an eye on the exits, and understand that it could change pretty quickly. Anyway, that's all I have. Have a wonderful day. I will see you tomorrow.